Hello and welcome to CryptoTubeNow, the podcast where we talk about all things crypto and blockchain. I'm your host, and today we're going to discuss one of the hottest topics in the crypto space, Bitcoin ETFs. Bitcoin ETFs are funds that track the price of Bitcoin and trade on stock exchanges, allowing investors to buy and sell Bitcoin without having to deal with the technical aspects of owning and storing it. Sounds simple, right? Well, not quite. Bitcoin ETFs have been a long-awaited and controversial development in the industry, as they have the potential to influence the price and adoption of Bitcoin and the crypto market in general. But how exactly do Bitcoin ETFs work, and why are they so important? To answer these questions, we need to understand the difference between two types of Bitcoin ETFs, spot and futures. Spot Bitcoin ETFs are funds that have to acquire and hold the underlying asset, Bitcoin, of which there is a limited supply of 21 million. Futures-based Bitcoin ETFs are funds that track the price of Bitcoin futures contracts, which are agreements to buy or sell Bitcoin at a predetermined price and date in the future. The main difference between these two types of ETFs is that spot ETFs create more buying pressure and scarcity for Bitcoin, potentially driving up its value, while futures ETFs do not have a direct impact on the supply and demand of Bitcoin, as they do not involve the actual purchase of the cryptocurrency. Spot ETFs are also more cost-effective and transparent, as they have lower fees and track the price of Bitcoin more accurately, while futures ETFs are subject to higher fees and price discrepancies, as they depend on the performance of the futures market. So, why are spot ETFs better than futures ETFs, and why are they so hard to get approved? Well, the main reason is regulation. Spot ETFs require more regulatory oversight and compliance, as they involve the custody and security of Bitcoin, which is still a relatively new and unregulated asset class. Futures ETFs, on the other hand, are easier to regulate, as they fall under the existing framework of the futures market, which is already well established and supervised by the authorities. This is why the U.S. Securities and Exchange Commission (SEC) has been more open to approving futures-based Bitcoin ETFs, while rejecting or delaying the approval of spot-based Bitcoin ETFs. In fact, the U.S. was the last major market to approve any kind of Bitcoin ETF, after Canada, Brazil, Europe, and Australia had already launched their own versions of the product. However, the U.S. finally broke the ice in October 2021, when it approved the first Bitcoin futures ETF, followed by several others in the subsequent weeks. This was a historic moment for the crypto industry, as it marked the entry of the largest and most influential market in the world.
When the SEC approved the first spot Bitcoin ETF in the US, after years of anticipation and speculation, this was a huge win for the crypto community, as it signaled a shift in the regulatory attitude and recognition of Bitcoin as a legitimate and valuable asset class. The spot Bitcoin ETFs quickly attracted over $10 billion of inflows in less than a month, as investors flocked to get exposure to the cryptocurrency in a convenient and regulated way. Some of the inflows came from investors who switched from other crypto investment products, such as the Grayscale Bitcoin Trust, which saw over $1 billion of outflows in just a few days. The approval of the spot Bitcoin ETFs also had a positive impact on the price and adoption of Bitcoin and the crypto market in general, as it increased the demand and liquidity for the digital assets. Bitcoin reached a new all-time high of over $100,000 in March 2024, while the total market capitalization of all cryptocurrencies surpassed $3 trillion for the first time. Bitcoin ETFs also helped Bitcoin become a more mainstream and accepted asset class, as they provided more legitimacy and regulation to the crypto space. Bitcoin ETFs also enabled a new suite of financial products, such as futures, options, and collateralization, that offered more opportunities and risks for investors. Bitcoin ETFs also made Bitcoin more attractive as a hedge against inflation, as some investors saw it as a finite and scarce resource that could preserve or increase its value over time. But not everything is rosy in the world of Bitcoin ETFs. There are also some challenges and drawbacks that investors need to be aware of. For instance, Bitcoin ETFs are still subject to volatility and market fluctuations, as they depend on the price of Bitcoin, which can be influenced by various factors, such as supply and demand, news and events, sentiment and speculation, and so on. Bitcoin ETFs are also subject to regulatory uncertainty and risk, as they may face new rules or restrictions from the authorities, especially in the US, where the SEC has been known to be cautious and conservative when it comes to crypto-related products. Bitcoin ETFs are also subject to operational and technical risk, as they may encounter issues or failures with the custody and security of Bitcoin, such as hacks, thefts, or losses, which could affect the performance and reputation of the funds.
So, what does the future hold for Bitcoin ETFs, and what are the implications for the crypto industry? Well, no one can predict the future with certainty, but we can expect to see more innovation and competition in the space, as more players enter the market and offer different types of Bitcoin ETFs, such as active, passive, leveraged, inverse, and so on. We can also expect to see more adoption and integration of Bitcoin ETFs in the mainstream financial system, as they become more accessible and familiar to investors of all kinds. We can also hope to see more positive and constructive regulation of Bitcoin ETFs, as they demonstrate their value and potential to the authorities and the public. But we also need to be careful and vigilant, as Bitcoin ETFs are not a magic bullet that will solve all the problems and challenges of the crypto industry. Bitcoin ETFs are still dependent on the underlying asset, Bitcoin, which is still evolving and maturing as a technology and a network. Bitcoin ETFs are also not a substitute for the original vision and purpose of Bitcoin, which is to create a decentralized, peer-to-peer, and censorship-resistant system of money and value. Bitcoin ETFs are just one of the many ways to invest in and benefit from Bitcoin, but they are not the only way, nor the best way, for everyone. That's why, as crypto enthusiasts and investors, we need to keep learning and exploring the different aspects and dimensions of Bitcoin and the crypto space, and not just focus on the price and the profits. We need to understand the history and the philosophy of Bitcoin, the innovation and the challenges of the technology, the opportunities and the risks of the market, and the impact and the potential of the industry. We need to be informed and critical, but also curious and open-minded, as we navigate this exciting and complex world of crypto. And that's what we aim to do here at CryptoTubeNow, to bring you the latest and the greatest insights and analysis on the crypto space, and to challenge your thoughts and opinions on the most relevant and controversial topics. We hope you enjoyed this episode, and if you did, please like, share, and subscribe to our channel, and leave us a comment below with your feedback and questions. And don't forget to tune in next time, when we'll talk about another hot topic in the crypto space. Until then, stay safe and stay crypto. This is CryptoTubeNow, signing off.